Good evening, everyone. This is Endrit Cela, your host for today's special evening episode of Capital Markets Quickie. Today, we're diving into some insightful research from SEB for December 2023. Let's get started. All right, so November was a fantastic month for global bonds and equities, right? We saw everything rally as the market started expecting rate cuts thanks to dropping inflation and central bank hints. But let's be real. We can't expect this super fast pace to keep up. Still, things are looking up for a gradual recovery in 2024. Now, let's talk about those rate cuts everyone's buzzing about. In October, folks were still wary of more hikes. But now, the markets are betting on a rate cut as early as March, with a total of nearly 125 basis points in cuts by the end of 2024. That's a big shift. Financial conditions are easing up too. Those tight conditions that had us worried about a possible recession, they're reversing, signaling maybe a bit of a boost this winter. The World Manufacturing PMI ticked up a bit in November, although it's still under 50, hinting that inflation risks are cooling off. But let's be cautious here. We're talking tactical, not strategic change. We've seen similar patterns in 2023, but they were short-lived because of rate hikes. The central banks like the Fed and ECB are still playing it safe, linking their dovishness to subdued growth. So, a too strong upswing might delay those rate cuts. Now it seems we're in a sweet spot for a soft landing followed by a gradual recovery. The US economy is in that just right zone where growth is slow enough to keep inflation in check, but strong enough to avoid a recession. If this keeps up, the Fed might just start a sustained expansion. But remember, there are risks. If conditions ease too quickly, the Fed might push back the first cut. And if the labor market gets too weak, consumer spending could dip, risking a recession. However, for now, it looks like things are balancing out. Let's not forget, not all rate cut cycles bring joy. While the lead up to rate cuts is generally positive, the actual cycles can be hit or miss for equities. The last three coincided with recessions, leading to significant losses. So, the real joy comes only if a recession is avoided. Lastly, SEB suggests leaning towards early cyclicals in segments like small caps, Swedish equities, and clean energy companies. They're shifting from a neutral stance with a defensive bias to a more weighted approach towards these areas, expecting positive returns for both stocks and bonds in the early phase of the cycle. And that's your December 2023 market outlook based on SEB's research. If you want me to do this more often, please let me know in the comments below. I hope this episode gives you some valuable insights. I'll be back tomorrow with more updates. Until then, stay informed and invest wisely.